Good morning or afternoon or wherever you are in this country. Thank you for joining us here today. For ourselves and for a lot of other businesses, it's now adjusting to what we would call the new normal. So we're now back in the marketplace and adjusting to that, understanding what that looks like. But how are businesses operating and adjusting to this new environment? Ben, why don't you tell us a little bit about yourself and Constructive?
Yeah, no, thanks, Nima, and certainly thanks for the opportunity. Ben Fertig, I'm the president of Constructive Loans. A little bit about my background. This September, to the extent that the world gets there, will mark my 24-year anniversary as a mortgage banker. And the last 8 of those have been exclusively in the residential investor loan market. I started Constructive Loans in partnership with what is the largest specialty servicer of residential mortgage assets in the country. Now, Constructive originates both fix and flip loans and both portfolio and single asset rental loans. 80% of our historical origination population and about 95% of our current origination population has been single asset rental loans. And then 90% of those have been originated through some type of a third party partner, whether that be a broker partner or a correspondent relationship. For us, the big one is third party origination. We want to do loans through third parties. We've got a very easy contract for people. We'll do it wholesale. We'll do it correspondent. That's the way that all of our systems are set up. We've got technology and systems and processes in place to, that specialize in that type of origination. And that's, again, predominantly what we do.
And I wanted to clarify that. So it's almost 90% of the rental product origination actually comes third party to you.
90% of our single asset rental product comes third party. 80% of what we originate overall is a single asset rental product.
Got it.
So 90% of that 72% of what we do is a third party single asset rental loan.
And then, we can kind of just talk about the ecosystem, because I think that's the other thing that really identifies and makes this a product different than a typical balance sheet product. And so we'll just talk about kind of who are the participants in the transaction and what do they expect from one another. Oftentimes, I get, for example, lots of questions about capital sourcing. And oftentimes there's hey, can I cut out the middleman? Can I cut out the Constructives of the world, right? Because ultimately why can't I just go to Blackstone or whatever it is and start negotiating these agreements myself? Yep. And so, oftentimes I have to kind of explain, like, here's the ecosystem, here's what every participant in the ecosystem is looking at. And so, right. Do you have a giant balance sheet and a very, because if you don't, they're not going to talk to you. There's no interest in the conversation.
Quite honestly, getting to the Blackstone might be the easy part. Getting to the Blackstone is probably easier than finding how you're going to get to the Blackstone, right? Finding a warehouse line to allow you to originate non-QM loans is a little bit more difficult, and I think we'll talk about that. Like, Blackstone will buy them from you probably if you could do enough from them, and you can figure out how you're going to fund them. But if you're a bridge originator and you originate a bridge loan that's got a 12-month maturity, and you get stuck with that loan, you probably got a decent interest rate, and you've got something that you don't think that the duration is going to be 30 years on. I mean, you get stuck with 30-year paper at 6%, and most originators aren't capitalized to be able to deal with that.
Right.
And then if you hit the black swan that we did, like we've been talking about since the beginning here, you've got to be ready to absorb a loss, and those are the kind of things that we're insulating our third-party clients from. But I think that, like anything else, I mean, speed was always something that has been important in private lending. I mean, we tried to pass that along so that the ultimate borrower experience could be better. But, look, I mean, at the end of the day, our biggest value add was being able to provide consistent, reliable capital.